All right, we're live. So my name's Amar Shah. This is Kyle,
Hello?
and today we're going to be talking about, this infrastructure bill looks like it's going to go through, and how are we going to pay for it? So this is a little bit more about taxes and what will probably need to happen in order to pay for some of this infrastructure, right? But before Kyle and I get started, I want to share my screen so I can have our disclosures up. Again, Kyle and I are haven't taken your accounts into account. We are. Can you see this, Kyle? Is this coming
Yeah.
up? There we go. Yeah. So we haven't taken your accounts into effect. We haven't taken your situation into account. This is strictly educational purposes, for educational purpose. Anything else that I'm missing there, Kyle? No client agreement has been entered. What else do we have to say?
That's what I was going to just say is that we're not in a client relationship with most of our viewers here. And if you have any questions, always feel free to reach out. Amar and I will be available. Our contact info will be in the description below.
So what is this infrastructure plan? What is like the main bullet points behind it? It's like so it's going to be a blueprint essentially for getting bridges, infrastructure, broadband. What else is in there?
There's a lot packed in there. So the total bill came out to 3.5 trillion is kind of what the number I saw floating around, which 10 years ago, that number would have been unheard of. And during COVID times, I feel like those numbers just kind of fly around the headlines and we kind of overlook them. But yeah, the gist of it is that that's a lot of money, right? And the government is going to need to fund those unfunded liabilities at some point, the already growing unfunded liabilities. I don't want to get into the merits of how or why or the politics or Democrats or Republicans or anything like that about the infrastructure bill. But I think as it relates to our clients, it's going to or likely could affect you on your taxes for this year or for next year. So with the infrastructure bill out of the way, I think the next thing on the chopping block would be tax law changes.
And tax law specifically would raise to raise money to kind of even out this budget, right? This I know when the bipartisan group got together, they said there's going to be no tax rate increase, and that's how they got this passed on a bipartisan basis. But I don't think that's true. I simply don't think that's true. And I think we're looking at three key areas where we're going to have increased taxes, right? So one of the areas is income tax. That, at least for the top bracket, is almost somewhat of a non-negotiable, right? It's pretty much certain. So you want to talk a little bit about that, Kyle?
Yeah, so with the Trump tax cuts that passed at the end of 2017, they were implemented January 1, 2018. So we've been a little bit over 3 years now under this regime. The top income tax bracket went from 39.6 down to 37. And then they took away a number of the brackets. And so kind of consolidated a few of the brackets. So a lot of kind of middle income taxpayers kind of fell in that 24 to 32% range.
Right.
Whereas the previous tax regime, it would have been probably in that 32 to 35% bracket. And so a lot of the middle income taxpayers got a little bit of a tax decrease, and the top taxpayers definitely got a tax decrease for the most part, unless you're in California or New York, as you know, Amar. So there's a lot to unpack there, but just in terms of just the rates itself, if the Trump tax cuts were to be repealed, those would go automatically back to 39.6 would be the top rate.
And those are already set to sunset in 2025, right? So
exactly
what we're talking about is for that top tax bracket to be that sunset to be accelerated to either next year, predominantly seems like something that could happen. And that rate would go from 37 to 39.6, correct?
Yeah, and that's just the income tax rate. There's also a lot of talk about kind of the net investment income tax. The 3.8% tax would apply to a lot more taxpayers and business owners. The additional Medicare tax could increase as well. There's a lot to keep to monitor and keep track of, and it's going to affect everybody slightly differently. So if you're a business owner, or if you're an executive or a high earner, there's going to be different considerations for each person in terms of income tax.
Yeah, and it's good that you bring it up, because that's income tax. Another part of where people that have high incomes get their income is through capital gains, right? Through investments. And so one of the things that have been talked about is raising the capital gains rate for those who earn $1 million a year or more. Now, we don't know if this is going to be at $1 million. I personally think it's not going to be at $1 million. This 400,000 number is just too frequent in all the different pieces, that I think the number will go down, but then they'll try to get a wider base. So individuals whose household income is over 400,000, but nevertheless, it will be an increase in capital gains, right?
Yeah, so that was the proposal earlier this year from the Biden administration that you touched on, Amar, that anybody over $1 million or more, they would no longer get long-term capital gains tax rates, which is around 20%, and then would go to the 39.6% top tax rate. So you get no preferential rate for long-term investments under that proposal. But realistically, I think that, I think you're kind of right on the mark there, that they'd try and get a broader base with maybe lowering down that $1 million, but not going all the way up to 39.6% for that income tax rate for the new capital gains rate.
Maybe 28%. I mean, I remember a long time ago, it used to be 28%, right?
Yeah, and so I've been telling clients I'd expect something maybe in 28 to 32 is kind of the range. I think a lot of people realistically think it would fall out. So I think, they start the negotiation at 40 and it's at 20. Well, they're probably going to meet somewhere around 30. I think that'd probably be a realistic expectation. And, I think by the time that the law goes into effect, it's probably going to be too late to act, in that, they'll have a little bit of a retroactive element from when they sign the bill as to when that new capital gains rate goes into effect. So that could be, 6 weeks, it could be 6 months, it could be all of 2021. We don't really know. But there is precedent that there would be a retroactive element, and I think that would probably be integrated into a capital gains tax hike. So you want to be monitoring it. And I've been telling clients, if you're deciding between selling now and December, sell now. There's more likelihood you get locked into that, grandfathered in with the current capital gains tax rates. Is that a guarantee? Absolutely not. But there's a higher likelihood the sooner you sell it, the more likely you'll get grandfathered in.
Yeah, it's very hard. I mean, I find for individuals to make business decisions or investment decisions when things can be retroactive. It's very difficult. And so that capital gains, I know you said 39.6 being the income tax rate, so that but there's also net investment income tax on top of that, right? So there would be another 3.8%.
That's correct. Yeah.
Yeah.
So if you have 39.6 rate, and then you pay the 3.8%, and then you pay California income tax at 13.3%, you're looking at 55 to 60% tax rate on capital gains
for people,
which is quite the change from mid 30s that you're looking at right now. So it's quite an extra tax bite for sure.
And then so the last part, which has been talked about, is the wealthy estates, right? So right now, a married couple has a exemption amount combined of 23.4 million, and anything above that is taxed at 40% federal estate tax under current law. And they've talked about, changing that to unappreciated capital gains, or a tax even when there's no sale. Talk a little bit more about that.
Sure. So now with the estate tax, the exemption right now is a little bit over $11 million each. So for federal estate taxes, you have to have an estate above around $22 million to even be considered taxable if you were to pass away at that time. So usually when you pass away, if you're under the exemption, you have no estate tax. Let's say you're over that $22 million exemption. Any excess right now would get taxed at 40%. Well, that $22 million number is probably going to go down to, in 2025, it'll probably go down to $11 million if nothing happens. And it could be lower than that if they act on it sooner. So it could be $3.5 million each. So any estate over $7 million would be subject to this estate tax. And another tenet of kind of estate taxes is that anything you inherited typically gets a step up in tax basis. So if your parents have $1.5 million home and they paid $50,000 for it in 1950, well, usually when you inherit it, your basis becomes $1.5 million. Well, that under the current proposal, that would go away. Your basis would remain $50,000, and when you go to sell that property after your parents, pass it on to you, you'd owe $1.45 million in capital gains. And then another tenet of that is that they would also, potentially tax you at that $1.5 million, for the home. You have unrealized gains at the time you pass. Well, they're talking about taxing that as well. And so I don't know, which one of those they're going to choose, but that's all kind of floating around out there. And so wealthy families might have a lot more tax considerations, upon inheriting any assets. Yeah. And it could affect a lot more people than it affects right now. I think it's kind of off the radar for most, middle to higher income families. It's really usually the uber wealthy that are really aware of the estate tax provisions on the federal tax side. There's also state estate taxes, which is another consideration, another topic for another day.
Yeah. But not all states have an estate tax. So just broadly speaking, that would be done at the state level, and each state has their own. Is Washington still 2 million or somewhere around there?
We actually have the highest estate tax in the country. So it's any estate over $2 million.
Yeah,
it gets about a 20 to 22% tax rate.
Yeah. So when you hear about this and you're going, gee whiz, what can I do? I mean, there's really only 4 things you can do. Is first, you can start spending your money, enjoying your hard work, your wealth, right? The second thing is that you can give your money to your children, grandchildren, charitably. You could also be charitably inclined and donate to charities through donor advised funds, charitable remainder unit trusts. And these are all tax efficient vehicles that, to bring the overall size of your estate down, but also give some credits towards paying other taxes that you may owe. And then the fourth is it's actually just paying the taxes and keep things simple. So you want to maximize 3 out of those 4, I think, for most people. So
that's a big long conversation for another topic, I think.
Yeah, there you go.
Today, just the tax law changes are on the horizon, I think, and I think we've got a pretty good shot of some pretty significant changes by the end of the year. So
yeah. So again, if you found value in this little quick discussion that we had here, please feel free to reach out to us, put comments below. We do our best to read as many as we can. And that'll also give us ideas for future videos.
This has been good. Like I said, there's a lot of topics we covered there. So if you have any follow-up or any questions, we are happy to opine. So please feel free to reach out to us either in the comments below or at our contact information. So
thank you, Kyle.
All right. Thanks, Amar. We'll talk soon.
Bye.